Wagwan, multifamily enthusiasts. Welcome to another episode of the Multifamily Real Estate Experiment Podcast. Look, today we're going to be talking about a topic that is important. It's really important to folks who are very affluent in our society. However, we are in the age of information where we have no excuses as to why we cannot leverage some of these benefits, no matter what level you are in your financial journey. So today we're going to talk about maximizing your tax benefits in real estate with cost segregation. And today we have an extraordinary guest for you. But first, I'm Hutch, the marine investor, your host. And today we're joined by Eric. He is the vice president of the national accounts at Cost Segregation Authority. Eric, expertise in cost segregation, it helps owners like ourselves and you potentially, if you're not invested in real estate yet, optimize tax savings through specialized depreciation strategy. And he's here to spend some time with us to share insight on tax incentive, bonus depreciation, and the effect of possible legislative change. Eric, I want to welcome you to this episode of the Multifamily Real Estate Experiment podcast.
Thanks, Hutch. I'm glad to be here. Thanks for having me.
Yes, sir. Before we get into the meat and potato of things, brother, do you have a favorite real estate quote or mantra that drives you?
That's a good question. I don't necessarily have a quote. I've had to learn the hard way throughout my real estate journey. I don't know that it's a quote that anyone said, or it's more just a lesson that I've learned, and that is to stay in my lane and know what I'm good at. And you can't be an expert in everything. If you're good at sourcing deals or finding deals, but you're not good at marketing them or
Mhm.
managing those properties, then make sure you get a good manager, a good person to help manage those. I've had to learn the hard way. I tried to do it all myself at first, and it was very difficult. And I've had to learn to build a team around me of, I know what I'm good at, and I just need to
Right?
stay in my lane and keep focused. And then all the stuff I'm not good at, I partner with people who are good at those different things and bring them in. So not necessarily a quote, but just a word to the wise. Take it from me. I've learned the hard way. You can't be an expert at everything.
No, it's definitely a really cool life lessons there that you share with us, right? Because I think, especially when you're younger folks, the world, society, teachers, parents, a lot of folks around us that are very influential really encourage you to work on your weaknesses because you're already stronger in some areas. However, I think we're realizing that we are all born different to do different things in this society, this world. And some people are just really good at things and really enjoy doing certain things. And that's why they talk about the who, not the how. So you have a great vision of what you want to accomplish. And if you're lucky enough to be able to have this abundance mindset, then you bring the people into that things you're aspiring to do, and you find a who to do the how that gets you to that place that you want to go, especially in the business ventures. I appreciate you sharing that with us.
Oh yeah, no problem.
Yes, sir. So look, cost segregation is not something that I knew about before I actually start diving into real estate and starting to acquire larger properties. Most investors and owners, they are focused more on smaller asset that typically we're not needing to think about cost segregation because a straight line depreciation, we're used to that. And our tax guy would tell us exactly how that works, right? It's very beneficial as well. However, when we start thinking a little bit bigger and start acquiring bigger properties, we get exposed to different words and different vocabulary. So this one, known as cost segregation, can you break it down for our listeners and help us to understand cost segregation at its foundation level?
Sure. That's a great question, Hutch. So cost segregation really is just accelerated depreciation on your real estate assets. So one of the great benefits of owning real estate is the ability to take what they call a depreciation expense each year against your income. So think of it when you buy a building, each year that building, the structure itself deteriorates over time. And the IRS knows that. And so they allow you to take an expense over time. Now, for commercial properties, that time period is 39 years. For residential properties, that time period is 27 and a half years.
Mhm.
So just to make the math easy, Hutch, let's say you buy a $390,000 office condo. You would take 390,000, divide it by 39 years, and you're going to have essentially a $10,000 write-off every year for the next 39 years, which is great. That's everyone was looking for write-offs. That means that If I have 110,000 of income that year, instead of paying tax on 110, I get to use this $10,000 write-off, and now I'm only paying tax on $100,000 of income.
Right.
That's called straight line depreciation. That's what a lot of us investors do. The problem with that, Hutch, is I may not own my property for 39 years. I want my deductions now versus taking 1/39 equally over the next 39 years. And the way I can do that is through an engineering-based study or cost segregation, where we
Right.
come in and, just as the name implies, we're segregating the cost of your building into different buckets, per se.
Hmm.
So when you buy an office condo, you don't just buy the land and the walls, you also buy some flooring, you buy some window coverings, you may buy part of the parking lot, you may buy some cabinets, some countertops. All those things I mentioned, the IRS says should be depreciated over 5, 7, or 15 years, but certainly
Okay.
not 39 years. And so, again, just as the name implies, we come in and we take your $390,000 purchase price and we say, okay, of that 390,000, 97,000 of that was for short life 5-year assets, things like carpet, countertops, cabinets, etc. Some of that was for the land improvements, parking lots, curbs, gutters, asphalt, retaining walls, outdoor lighting. And
Right.
so we take that $390,000 purchase price, break it up into different buckets, and by doing that, it allows us to depreciate at a much faster rate. The reason we want to do that, Hutch, is because one is inflation. A dollar today is worth way more than a dollar in the future. So give me my deductions now. Therefore, I can take that deduction, create tax savings, take that extra cash flow, and go buy another property. Or I can pay down my debt, or I
Hmm.
can invest it in Bitcoin, do whatever you want with that money. But at least I have that money now versus letting the IRS hold on to it for the next 39 years. So that's cost segregation at a high level. We're just front loading or taking the depreciation at a faster rate.
Got you. Yeah. So I get it. The government allows us to appreciate this asset. Doesn't mean that the value of my property is going down over the years.
No, your value is probably going up depending on the market, but in
Right.
most cases, your value of your property is going up. It's just that as that property is used, there's wear and tear on that property. For example, if you had a multifamily property, over time, you're going to have to put in new carpet, new flooring, potentially new windows, new roof, new walls, new cabinets, countertops. So you're wearing that property out over time. Even though the value of the property is going up, rents
Hmm.
are going up, cash flow is going up, land value is going up. So that property is worth more today, more dollars,
Hmm.
but you get to take that non-cash expense because of the wear and tear on that building.
Got you. So look, for those folks who have not really used cost segregation, right? Yes, the value of the property is not going down. If I take all this depreciation from this property, what happened when I sell the property to somebody else? Do they gotta make everything new to get some depreciation again?
No, so your depreciation clock
Right.
starts over every time a property changes hands. So let's say you buy a property for $1 million and you sell it
Hmm.
to me 5 years later for 2 million. When I start depreciating that $2 million property, my starting basis is that $2 million. Yours is the $1 million. It's not for the life of the property, it's for your ownership individually as a taxpayer. So when you buy a property, you do your cost seg, you determine all the stuff that's in there. So, for example, in that example I used where you bought the property for 1 million,
Right.
let's say we would value your cabinets at, let's say, 50,000. When I bought that same property for 2 million, I just paid double for those cabinets. So now my cabinets cost me 100,000.
Yeah.
And so that's where we start depreciating based off of the purchase price. Now, when you do sell the asset, you do have to pay some of this depreciation back in the form of what they call depreciation recapture. I'll back into this example because I think it makes more sense. When you buy a property, let's use the example we had. You buy a property for 1 million, you sell it 5 years later for 2 million. When you go to settle up with the IRS, you're telling them that everything is doubled in value in your building. Your land is worth more, your
Hmm.
walls are worth more, and you're also telling them that your dirty, stained, nasty carpet is worth double what you paid for it. Well, carpet is a 5-year asset. So in that example where I bought the building, held it for 5 years,
Hmm.
the book value of my carpet is zero.
Correct.
I shouldn't be selling my carpet for more than I've paid for it. The problem is, Hutch, is when you don't do a cost seg study, you don't have everything broken out. You just have one lump sum. I bought this office and all this stuff for 1 million. I'm selling this office and all this stuff for 2 million, and you end up paying tax on that $1 million of gain. When what should happen is you should break it up and say, my land, and I bought it for $1 million, sold it for $2 million. My land and walls went up in value, but my cabinets, my countertops, my flooring, that all went down in value. And so you end up paying less tax upon sale. There's a rate arbitrage where you're taking your deduction at an ordinary income rate, let's call it 35%. When you sell the property in 5 years, you're paying some of that back, but you're paying it back at a 20% capital gain rate and saving the spread. That's the most simplest way to describe it. So take your deduction at a high rate, pay back some of it at a lower rate at a future date, and then you're saving the spread. And that's the whole idea behind cost seg. Not to mention you've had that money to reinvest for the last 5
Correct.
years. So
Yes. So it sounds like you're saying that at the different level, 5, 7, or 15 years, if we want to keep the property for 5 years, and we did our accelerated depreciation on the cost segregation study, then those things that if we depreciated 100% of those things with a 5-year lifetime, say for example, for property, and we only accepted the depreciation value for those things that had 5-year limits, we could potentially not have even though we got to file the taxes, potentially not have to pay any taxes on that loss. You're saying?
any tax on the 5-year asset go over to
Correct.
capital gains. But again, if you're taking your deduction at 35,
Right.
paying back at a 15 or 20% capital gains rate, there's quite a big spread there. And that's what you call permanent tax savings for yourself.
Gotcha. So why is a lot of wealthy people so excited about these tax strategy, even though they're not too excited about it phasing out?
So the reason is it just creates cash flow in those early years of ownership. And
Right.
so it's a great way for you to build wealth over time. Instead of giving that money to the government and letting them sit on it for 39 years,
Hmm.
you get to take that tax savings and reinvest it, pay down your debt, go buy new properties. There is something called bonus depreciation, Hutch, which we haven't touched on, but it puts cost segregation on steroids.
Okay.
And so it was part of the Tax Cuts and Jobs Act where bonus depreciation was really ramped up at the end of 2017. Um, Donald Trump was our president. Donald Trump owns real estate, and Donald Trump was very favorable to real estate investors when he revised the tax code.
Hmm.
And so with bonus depreciation, you can get a huge deduction in the first year. Any assets bought between 9/27 of 17
Hmm.
and 12/31 of 2022, they were all eligible for 100%
100%.
bonus. And what that means is when we do our cost seg study and we identify, let's say, again, let's use easy math here. Let's use $1 million property. You buy $1 million property, we usually will segregate around 30% of that. So
Gotcha.
we'll find $300,000 worth of stuff that falls in those short life assets on average. With 100% bonus, you got to take 100% of that 300,000 all in year one. You didn't have to spread it out over 5, 7, or 15 years. You just got to take an immediate deduction of the whole amount in year one, which was huge. That's a $300,000 write-off in that example.
Yeah, I think
Now,
what is cool about that example is that $300,000 of that $1 million could be all of your equity that you have in that property, right? So you pretty much you invest in $300,000 and you're showing a passive loss of $300,000 for that first initial year, right?
yeah,
Am I getting that right?
yep, you got it. I just did the math here on my calculator. If you didn't do cost seg, you would get a $25,000 write-off. By
Okay,
doing cost segregating, you're getting a $300,000 write-off. So you can see the power of it. Now,
right.
bonus depreciation or 100% bonus depreciation did phase out. You had to have bought a property again between 9/27 of 17 and 12/31 of 22.
Mhm.
If you bought a property in 2023, you were eligible for 80% bonus. 2024, it's 60%. Next year, it drops to 40. It goes down 20% each year until 2027 when it's down to zero. The good news is, hopefully, fingers crossed, Congress actually put forth a bill earlier this year in 2024 that said, hey, let's extend this 100% bonus. It went to the House, voted on it almost unanimously, bipartisan support. It passed the House, got to the Senate, and there was a few senators that said, wait a minute, we're in the midst of a presidential election this year. We don't want to pass anything this year because then it's going to look good for Biden on his watch. So we're not going to pass anything. So they stalled it. They killed the bill, but it has bipartisan support. So here's the thing. At the end of this year, the presidential election happens here just in a few days.
Mhm.
When that happens, regardless of who wins the presidential seat, I think Congress will get back together after the presidential election. They're going to agree to a comprehensive tax bill. I do think it'll include the extension of 100% bonus. They'll vote on it early next year. My guess is that we are going to have 100% bonus for 2024's tax returns. But right now it's 60%. We'll have to wait and see.
Do you think it might go retro back to 2023? 23?
Don't think they'll go back to 23. And here's the reason
23?
why. Because everyone had to have their taxes filed by October 15th. So
Mm-hmm.
everyone's already filed 2023.
Right.
2024's taxes aren't due until next year, next October, if you
Got
extend.
you.
I think it'd be very hard for them to retro it for 2023. There would have to be a lot of amendments, or they'd have to figure out a way to honor that 100% bonus. So my guess is if you bought something in 23, you'll be stuck at the 80%, which Hutch is very
Good. That's good.
Yeah, we were doing cost seg when there was no bonus, and you just
Right.
taking 39-year assets and moving them to 5-year assets and splitting them up over 5 years. So now we get that extra bump. So 80% was very good. I don't foresee them going back to 23. My guess is they would go back to 24, but
Got you.
surprised me before, so we'll have to wait and see.
Yeah, they surprise us all the time. And so this cost segregation is definitely a game changer. The last property that we closed on was almost 700 units over in Texas. One investor invested 100 grand, right? The cost segregation of that was right around $46,000 savings for the first year on the passive loss. It's a game changer for those people who really get in this game. If you have $100,000 sitting around that you've been saving for a very long time, right? Chances are it might not be working as hard for you as you worked for it. And what we're seeing is that a lot of folks are realizing that they can use that money to work at a significantly higher pace than it is in its current place, right? And that's where tax savings like bonus depreciation, acceleration depreciation comes in, where you can invest that money. And if you have a diversified portfolio that brings you some passive income, then you can use that passive loss. And if you're a savvy investor, you understand the difference between passive loss and just losing money, right? Passive loss doesn't necessarily mean losing money. It means that the government themselves, who are investors like yourself, create tax strategy for you and them to benefit to ensure that your money can continue to work better. Can you tell us, Eric, how can an investor use their passive losses?
Yeah, so passive losses in this instance, it's not
Yeah,
because the property's losing money, it's actually just a paper loss. So the
correct.
property's making money, but the deduction we're able to create by utilizing cost segregation and bonus depreciation is greater than the money that the property's making. So let's say the property's making 100,000, but you do a cost seg study and we create a $200,000 deduction.
Right.
On paper, the property looks like it's lost $100,000, but that's only because of that depreciation. It's a non-cash expense, so it's a paper loss. Now, that deduction, as you mentioned, as an investor, I can use that to offset other passive income. So if I am a W-2 employee and I've got two single-family rentals, and those single-family rentals, they make $50,000 each a year.
Hmm.
That $100,000 of passive income, I don't want to pay tax on it. So I could invest in one of your projects, create a $100,000 loss, use that $100,000 loss to offset my $100,000 of income from my rental properties. And in doing so, if I'm in a 37% tax bracket, I just saved $37,000 in taxes that I would have normally had to pay. So the active versus passive, I always think of it as I'm a W-2 employee.
Hmm.
What I do for a daily job is this cost seg stuff. My rental activity is passive. I don't do that actively. And so there's active deductions that offset active income, and there's passive deductions that offset passive income. There's some ways around it that we probably won't get into today about being a real estate professional. If
Right.
you or your spouse spends more than 750 hours a year doing real estate and more than 51% of their working time, they may qualify as a real estate professional. And then that's like the golden ticket. There's all kinds of
Yeah.
different rules that apply to them. But for the most part, these deductions for most of your investors are going to be considered passive, and they can be used to offset any other type of passive income.
Yeah, folks, if you listen to this episode and it's the first time you're hearing about cost segregation, it's really worth spending 30 minutes to an hour of your time learning a little more, because this is a catalyst towards your dollar amount, whether you're saving for retirement or you're looking to keep more of your passive income in today's earnings. Definitely spend some more time and dive into, or at the end of this podcast episode, we're going to learn how we can reach out to Eric. However, we are doing the work for you. And Eric, I want to ask you this question. Are there specific types of properties are scenarios where cost segregation has its greatest impact?
There are. So multifamily is great. Multifamily is good because if you think about apartment buildings, for example, there's a lot of stuff inside those buildings.
Right.
There's appliances in each unit, there's flooring in each unit, there's window coverings in each unit, there's ceiling fans, garbage disposals. So they get a higher yield in terms of depreciation versus if I go spend the same amount on an empty warehouse, I
Right.
might only segregate 20% of that because there's nothing in there. There's no stuff in there. So warehouses might get 20%, multifamily might get 30 to 35%. There are a couple really unique categories. One is
Yeah.
car wash. Car washes, when you invest in car washes, essentially you may be able to, the whole car wash may be treated as a 15-year asset because you're not really buying a building. When you buy a car wash, you're buying equipment typically,
Hmm.
and you're buying land improvements, curbs, gutters, concrete,
Right.
landscaping. So oftentimes those tend to yield really high results. And then gas stations and mobile home parks are the other two that are unique.
Yeah, mobile home park is definitely a game changer, right? Because if you just own the park and the improvement, the horizontal, the plumbings, right? The sewer line, the electric line, and just the pads
Right.
that these mobile home goes on, the improvement is so little. However, you buying that business for millions and millions of dollars, and the land is not depreciable. You know what I mean? So a lot of those improvements gives you a significantly higher cost segregation on your or bonus depreciation on your money, which I find to be super fascinating.
The thing is, and I'll just kind of end with this, Hutch, is you always want to make sure you obviously talk to your tax preparer,
Right.
tax strategist. Now, I want to make a clear distinction. There is a huge distinction between a tax preparer and a tax strategist.
Hmm.
As you start along your investment journey, it may be okay just to work with a tax preparer. You hand them a few documents, they run it through their software, and they tell you how much tax you owe. That is a tax preparer. As you start to build a complex real estate portfolio, it's very important to make sure you're working with a tax strategist, not just a tax preparer. So you don't want to just meet with your tax person once a year because chances are it's too late for you to impose any type of strategy. As you start to build your real estate portfolio, make sure you're working with somebody who really understands real estate tax and how that works to your favor. Because if you're going, nothing against H&R Block, but if you're going to Walmart, picking your stuff into H&R Block, they're not going to be able to talk tax strategy. They're just processing your return. They're just plugging your information into their software. It spits out a number that you owe the IRS, and that's the end of it. Where a
Hmm.
tax strategist will usually meet with you 3 or 4 times a year, talk with you about, hey, what type of income do you have coming in? What deductions do you expect to have this year? How do we create more deductions? So that when you do have to pay taxes, you're paying very little. We don't do tax returns. This is not a plug for myself. We just do this cost segregation, but I've seen so many investors leave money on the table by working with somebody who doesn't understand real estate. And as you start to build your portfolio, it's very important you're working with somebody who understands real estate.
Yeah, 100%. It's one of those things where you definitely need to get a who to help you that knows how to help you to keep more of your capital. Because look, we say this very frequently in this podcast that if you are creating jobs and housing, the government have created this unique things that a lot of us we call taxes, which we think is our patriotic duty to pay these taxes. Yes, there are taxes that you are obligated to pay. However, if you are providing certain service to the population, then there are benefits in the tax laws for you for doing certain things. Spend a couple $1,000s a year to save yourself millions of dollars
Yep.
over your lifetime because medical bills and taxes is probably two of the most expensive things that we will pay in our lifetime. If you got good insurance, then that's good for you. If you have a
Yep.
good tax strategist, right, who understand the way bonus depreciation or cost segregation strategy can build into your investments that work for you, then you get to keep more of your income. All right, so we're gonna go to the focus round, Eric. What do you
Right.
do for fun?
What do I do for fun? I actually play a lot of pickleball, believe it or not.
All
So
right.
um, I've gotten into that. I shouldn't say it's an old man sport because it's taking off like crazy. I like it because I'm getting older and you can't tell by me sitting here, but I'm actually 6'6". It's easy just to stand in the middle of the court, and not have to move too much.
What is one opportunity that was a game changer for you?
I took some money out of an old 401k that I had and I
Right?
invested it in an opportunity zone fund.
Nice.
where they're building micro apartments. That's been a game changer for me financially because I think that money is going to grow at a much faster rate. And there's going to be some significant tax advantages to that money versus just leaving it in a 401k at my old employer. Definitely something to look at. If you've got money just sitting in a 401k, make sure you find yourself a good syndication or a good general partner, somebody who can get you a good return. Because there's a lot of good returns out there in real estate that are higher than what you're getting on your 401k. You just got to make sure you're partnering with the right people.
Yeah, 100%. And one of the caveat is a lot of folks want to roll their money from a 401k over into a self-directed IRA, and that's a good thing. However, there's certain conflict with the tax law, right, where you might not be able to benefit from some tax benefits if you are investing with your self-directed IRA. So ensure that you're speaking to your CPA, your tax preparer, your tax strategist in understanding some of those and also some of the consequences of investing with your self-directed IRA into, say, a syndication, because you got things like the unrelated business expenses. I think it's the UBIT tax, right?
Yep,
So make sure you get a deep understanding of where
for
your
sure.
money is coming from to invest in different assets to understand your obligation towards paying taxes or your potential not benefiting from some of the tax benefits. So talk to your people, talk to the who that know the how, so you can go do the thing that you want to do.
That's right.
You
You
know, so
got
yeah,
it.
yeah, I appreciate that. What is your most important communication tip?
My most important communication tip is to humble yourself and know, going back to knowing what you're good at. I think you've got to be able to, anytime you're working with a team, you've got to be
Right.
humble enough to say, hey, I'm not good at this. This is where I made my mistakes. And so just communicating early and often
Mhm.
is so important. And to be able to identify when you have made a mistake. I really struggle working with people who can't admit their own faults because it doesn't help any of us in the big picture. Like we're all working towards the same goal, but if we're not honest with ourselves on what our strengths are, where our mistakes were made, what have you, then none of us can help fix the problem. And so I just think that being honest with yourself, being honest, being humble enough to know when you make a mistake, owning up
Right.
to your mistake, get it out there early. Don't hold on to it because it's just going to make things worse. That's the best advice I can give.
Yes, self accountability might be
There you
one of
go.
the most challenging things we do, right? I tell my Marines this, I tell my children this, and I tell myself this, that our superpower is self-control, right? And it's important that we are really thinking about our thoughts, right? Thinking about our thoughts and realize the way we're showing up. Maybe I am the problem in this situation, right? Maybe I should listen some more so I can learn a little bit more about myself or a particular situation so I can potentially add more value by communicating better. So, what is one thing you wish you understood earlier?
One thing that I wish I understood earlier, and I hate to go back to it because I've gone back to it three times,
Yeah,
but I learned the hard way about staying in your lane. I'll give you a quick story. I was 19 years old. I bought a new car. I bought a new stereo for my car, and they wanted $180 to install the stereo. I said to, and I spent quite a bit of money on the stereo, and I got a big subwoofer in the back. I was all
right.
excited. They wanted $180 to install it. I'm like, I'm not paying that. So I went home and I struggled for 3 days to install that stereo. I had to get a wire from the battery to the trunk of the car. And I was thinking about drilling holes underneath the car, drilling holes through this. I'm like, how in the hell do I get this cable from my battery to the trunk? So after 3 days of just headache, YouTube videos, I couldn't figure it out. I finally had to put my tail between my legs and I called the place where I bought the stereo and I'm like, hey, how do I get this thing from the battery to the back of the car? And they're like, oh, you just poke a hole through the little rubber bushing where you pop your hood. There's a cable from where you pop your hood. So, anyways, long story short, I spent 3 days of just hell trying to install the stereo. Once I finally got it installed, after about 2 months, it started shorting out and I had all kinds of problems with it.
Wow.
I'm not a radio installer. I did not stay in my lane. I tried to save the $180. I tried to take the cheap route. I would have been way better off spending the $180, getting it. They would have done it in an hour. It would have been done great. I wouldn't have had any problems with it. Instead, I wasted an hour or days of my time. Plus, I ended up having to pay them to fix it anyway. So,
Yeah.
long story short, thing with CPAs, don't, you already mentioned this. You can go get your taxes done for $100, $200, but you get what you pay for. And if you're not paying, I would much rather pay $1,000 to a CPA who knows what they're doing because they're going to save me $10,000 in taxes. And so, you always get what you pay for, whether it's services that you buy or products that you buy. I feel like you definitely get what you pay for. So I had to unfortunately learn that the hard way through the course of my life. But yeah, I'll end with that.
No, I got you, man. I've done the same thing too, man. I wanted to do a family project and install some vinyl planks in one of my single family homes. And in a year, we end up replacing the entire floor. So I went to Home Depot or Lowe's and got it professionally installed. We started
Yeah,
shifting. Look, I fixed aircraft like really good. I don't replace
you don't
floors
do
very
floors.
well.
That's right.
So last question before we get into contact information, right? Eric, to what do you attribute your success?
I grew up playing sports throughout junior high and high school, and I think that the biggest thing that separates those who succeed and those who don't is just hard work. There's
Yep.
no getting around the hard work. I'm sure you know this very well, but you have to put in the work. It takes thousands of hours to master any craft, and there's no cheating your way around it. It's if you want to get strong and big, you can't cheat yourself out of the push-ups you've got to do. You just have to do the push-ups. And
Gotta
so
go.
at some point, you have to buckle down, and hard work pays off. I am a firm believer in karma. You treat people the way you want to be treated, and the truth always comes to the top. So if you're not treating people the right way, eventually you might not get caught today or tomorrow, but eventually the truth will come to the top. It always seems to do that. Just good karma, treat people the way you want to be treated, and hard work will get you where you need to be.
Man, thank you so much. We're getting investing lessons and life lessons. I appreciate you, Eric. So, Eric, if our listeners want to get in touch with you, how do they do that?
Yeah, so the best way is just through our website. It's
Okay.
www.costsegauthority.com. My contact information's on there, my email, my phone. Please, listeners, use this as a resource. Like I mentioned earlier, we don't do tax returns at our firm. We just do these cost segregation studies and energy credits. So we'll usually partner with your tax preparer. But if you've got questions on real estate tax or depreciation, please don't hesitate to reach out. We don't bill by the hour or anything like that. We're here to help. We want to get you the information you need and do it in a way that works for you. So don't hesitate to reach out.
Thank you so much, Eric. Listeners, I want to thank you. Thank you for spending some time with us today to learn some more about this specific tool that can be a catalyst towards your financial journey in keeping more of your passive income. So I trust that you took a lot from this, a lot more research that you would need to do to get a deeper understanding about how you can benefit from cost segregation. You reach out to Eric or you can at his contact, or you can reach out to myself or Dr. Jones, and we can talk more about how our investors are benefiting from cost segregation through the bonus depreciation strategy. So until next time, Eric, thank you so much again for joining us, brother. Until next time, I'm Hutch, the Marine Investor, out.